Okay, so now we're going to go through and do step 4. So you can see here, usually we pull in, so this is, we're doing the regression beta, and usually we'll just go ahead and do, we'll average the 3-year weekly data with 5-year monthly, and we pull this from Yahoo Finance, but for the model here, we just included it already for you. So these are the stock prices on the individual days going back 3 years weekly, and these are the stock prices and the S&P for 5-year monthly. And so what you're going to do first here is you're going to calculate the change for each week. So technically the most accurate way to do this is you're going to do equals ln, and you're going to do the ratio of the two numbers. So you're going to do like see 1030 divided by 1023, and that's going to give you, the reason you do this is because it's continuous, and returns on stock prices, for example, are continuous returns. They're not like individual periods that you could just like add up the returns over time. So you do that and it'll give you the change. And we can go ahead and just double click down here because it's a little bit hard to copy it over, but we're going to do the same thing for all of these. Equals ln, and you just do the ratio. And we'll double click that to send it down. And we'll do the same for 5-year monthly. And we'll go ahead and copy these down. Now, yes, you could highlight, or you could go down to the bottom here. You could go across, and then if you do Control Shift up, you could copy the formula down. But a lot of times, if you are doing extended periods of time series data like this, that can be pretty cumbersome. So sometimes it is just easier in certain applications like this to just use your mouse and click on it. So now we have these changes in stock prices over different weeks and months. So what we're going to do is we're going to go into this cell up here where it says regression beta. We're going to do 3-year weekly. And so the theory behind this is, with a regression beta, what you're calculating is you're calculating the slope. So if the S&P 500 changes by 1% in a day, then what does that on average mean for the price of the stock? And so that's what your beta is. Your beta is essentially the slope between like how much does the S&P move, and then you can think of the Y value as how much does the stock move. So instead of running a regression through Excel or anything, we can use the handy formula. It's equals slope. And so we know what are the Y values. And this is for 3-year weekly. The Y values are for the changes in the stock price. And we can copy that formula. Or we can select all of those changes. And then we know the X values are going to be the 3-year weekly changes in the stock price. So we select all of those values. And we can enter and see we get a 3-year weekly beta here of 0.36. And then we can do again equals slope. We can select the changes for the stock price, and then we can do the changes for the index. And hit enter and see we get 0.36 and 0.37. So you can imagine when you're calculating a beta, the beta for the market is 1 because the market is 100% correlated with itself. And so for a lot of companies that are more of a component of the market, so you can think of like an Apple, Amazon, some company like this, they're going to be much closer to 1. But Walmart, because it's so stable and they're a little bit more resilient in times of market fluctuations, then they're going to be a lot lower. So you see that's why in this portion, on average, you're thinking that the interpretation here is that Walmart moves about 36% of the value that the S&P 500 moves in a particular day. So then what we're going to do here is we blend the two methods together and we use an average. This takes care of if there were certain periods of volatility or anything. Most services where you just go and find a beta, they're going to blend them together. They have multiple ways they're going to calculate it. And so we get a 0.36 blended beta here. So then what we can do there is we can go and take that to our WACC tab. Now we already on the WACC tab, we already included a few numbers. So risk-free rate, this is going to be the interest rate right now on a 10-year US Treasury. The equity risk premium is, from the beta calculation, you go over in Finance 3000. So this is, if you think of the CAPM formula, that's your equity risk premium. So it's the return on the market in excess of your risk-free rate. and it's the expected return on the market minus the risk-free rate. Then we have cost of debt. Cost of debt we calculated as the risk-free rate plus a spread, and that's a little bit more of a nuanced topic that we can cover in more depth, but for the purposes of this, we've just included it here. So what we can do now is we can go and do equals and add in this blended beta from the other tab. So we can go across here, and you can just link in that blended beta. So now what your cost of equity is, you're going to do equals, and it's just the CAPM formula. So it's your risk-free rate plus, and then you're going to do the beta times the equity risk premium. And that's going to give us a cost of equity of 2.77%. Now, going down a little bit further for cost of debt, so we include the tax rate and cost of debt. So the tax rate, we're going to use the effective tax rate, and we're just going to link this from the free cash flow tab. So we already have effective tax rate here. And your after-tax cost of debt is going to be your cost of debt times, and then you're going to do in parentheses 1 minus the tax rate. Now, why do we do this? The reason is because when you're calculating the value for the firm, well, when you have interest payments that you have to make on debt, those interest payments are tax deductible. So the way that we find basically the value of the tax savings from having debt at the company is we just multiply the cost of debt times 1 minus the tax rate, and that basically is an easy way, instead of just forecasting out all of the interest payments. It's just a really easy way to figure out what the value of the tax savings that we're going to save from using debt versus using equity. So now we have the cost of equity, we have the after-tax cost of debt here. We're going to need to link a few of these other things in for the capital structure. So shares outstanding, this is going to be on the free cash flow tab. We already hard-coded this in for you all. Current price, that was also on the free cash flow tab. And then market cap. So market capitalization is just your total shares outstanding multiplied by the current price. And this is the market value of all of your shares outstanding. Now, market value of debt, we already calculated the market value of debt here. Oh, sorry. So the market value of debt is on the free cash flow tab. We just have debt. And again, so a lot of times, the market value of debt might be different than what the book value of debt is. And the book value of debt is just how much we have it for on the balance sheet. But generally, a lot of times when you're building a model, you're just going to use the book value of debt. Usually it's a good approximation because the book value is relatively similar to the market value of debt, and also debt trades very infrequently. So it's a lot more difficult to find an accurate value for the debt versus for the equity, because we always know what the share price is, but a lot of times it can be difficult to get a quote for debt. So we just use the book value, and this includes the long-term debt plus the current portion of long-term debt, as well as any short-term debt that we have. So now what we need to do is calculate the percent of equity that our capital, and total capital is just like your market cap plus the value of debt that you have. So we want to find equity as a percentage of capital. So we're going to do market cap here divided by, and then we can do the sum of these two numbers here. So your market cap and your market value of debt. And we're going to do F4 to lock those cells. And that way we can just drag this formula down right here. So we can just drag it down. And now we see if we highlight these two numbers down here on the bottom right of Excel, you can see the sum is 100%. And we want to make sure that when we do this, that these equal 100%. Now for your WACC, the WACC formula is going to be you're going to multiply, it's just a weighted average cost of capital is what WACC stands for. So it's cost of equity times the weight of equity in capital plus, and you're going to do the cost after tax of debt multiplied by your cost of debt. So we're going to see that the weighted average cost of capital for this company is 2.59%. And all this means is that if the firm finds a project that they can make a 5% return on per year, well, that exceeds their weighted average cost of capital. So that would actually be a profitable investment for them to make. But if they had a project that they would only generate about 1% a year on, then that would not be profitable because that is less than their cost of capital. It's costing them more to fund that project and then they're going to generate on the project. That's just a really basic way of understanding it. But now that we have that weighted average cost of capital, we can go ahead and link that to the free cash flow tab here. We can do equals in the WACC of the assumptions page, and we can go ahead and link that there. Now you also see here hurdle rate. I think there's a note here, and it just says, yeah. So basically for certain applications, instead of using because this cost of equity number is so low, that means that on average, that's what they're expecting the equity holders to generate on their investment in this company. So that's obviously pretty low. But if I wanted instead a 10% return on equity, I could use in the WACC calculation, instead of using this cost of equity we calculated, I could use the hurdle rate. And what that would basically do is just when I value the company, it would be saying that we're going to find a value for the company that I could pay, and I could generate, based on what we think the company is going to be worth in the future, I would generate a 10% return on the equity that I invest in the company. So that's a very basic way of understanding that. And I think from there, we're going to move on to the next step. Okay, so now that we have the weighted average cost of capital done, we are going to need to discount the level of free cash flow. So we know that free cash flow is just how much cash they're generating that's going to be available to all investors within the firm. But we want to find a present value so we can find, okay, what's the value today of all of the cash this company is going to generate? And that's going to be the value that we're going to find for the entire firm. So how are we going to do this? We're going to do equals here. We're going to get the level of free cash flow in this year. And notice that we're not doing it for 2020 because after that time period is passed, that cash is already in the firm. So we know, if they generated right here 17 billion in cash in 2020, that's going to be either reflected in the cash balance or it was already spent on capital projects, or they returned it to shareholders in some way. So we only are valuing future cash flows, and we're just finding present value. So again, here we're going to just link this unlevered free cash flow right here, and we are going to divide it by, and then in parentheses 1 plus, and we're going to link the weighted average cost of capital, and you're going to want to hit F4 to make that a hard code, close parentheses, and then we're going to raise that to the power of this year here. So the time factor here is just the year. We're assuming that we're valuing this company as of the end of 2020, the fiscal year 2020. And so it's 1 year into the future. And we're going to close parenthesis on that. And we get here, this is the present value of, if in 1 year from today, I give you $16.2-ish billion at a 2% roughly cost of capital, this is what the present value of that is. So now we can just do Control-C, and I'm going to do Alt-ESF to copy that over. And you can see now here in all of these cells, I have here, what is the, as of the end of fiscal year 2020, what is the present value of this future cash flow? So here you can see we're just checking the formula. And as I go along here, the WACC is still the same WACC, but we're moving along with not only the unlevered free cash flow, but also the year number here. And I think with that, step 6, we'll be going through calculating the perpetuity and multiples methods, and the rest of the lessons will be focused on valuation.